Hi everyone, very nice being here. My name is Gaspard, I'm a protocol lead and one of the co-founders of APWine, which is a protocol building derivatives on interest rate. Today I'm going to talk about the dynamics of the interest rate market. Even though most of you must have been here for a few years, this is a space in DeFi in general that is very early stage with a lot of dynamics that are changing as protocols, users, and just the space in general is trying different types of paradigm, economic models, incentives models. And I'm going to walk you through different steps that are making the space more resilient, but eventually identifying some dynamics that we are taking or that basically justify how new actors are coming to DeFi and plugging themselves on that new decentralized finance environment and arbitraging as well. So before we go deeper into what the current situation is, do you remember those? Do you remember when in 2020, with liquidity mining, it would be quite profitable to take a loan, to supply it, to take another loan, to accumulate interest, to move all your funds that you took one bull market to accumulate on a platform that was proposing 5-digit APIs because why not wouldn't it be sustainable? And eventually you would end up losing or making a lot of money with that, depending on which side of the rug pull you are. But basically, that was the beginning of interest market for DeFi. That was where and when people started to look at DeFi, not necessarily understanding it, but realizing that you can make money with it. That you can make money with it and that the only thing that you need is just supply capital and close your eyes. And that started like that. And eventually, liquidity mining was great until it became that. And pretty much things started to arbitrage themselves there. And while we had new protocols, new dynamics, constantly changing the market and constantly iterating by building things that would then break and then new things would arise. We had a few actors, a few DeFi protocols that organically were actually building TVL, building volume, just on the base layer of this whole crazy environment of experiment. And the same layer we saw very recently with different events, we're actually taking quite some profit on that volume that were not very organic on top, but was generic organic activity on the base layer. And those protocols like Curve, like Aave, really stayed for many years, and with not that much change on a technical level, with not too many crazy things on a tokenomic level, but still gathering liquidity, making them quite efficient and quite usable from a user perspective or from a protocol perspective. You would have these new protocols being wiped out by flash loans and Aave making revenue on top of that, Curve as well. And that was kind of a dynamic there where you would have strong layers being built progressively, but generating revenues with a higher level, higher layer that were completely not necessarily sustainable. And that's kind of the fail-fast methodology that we had, not just in DeFi, but in crypto in general. Call it market cycle if you want, but often protocol we're trying something, then it grows or not, then it becomes too big to fail or not, and then eventually it fails and people learn or just launch a V2. But that's pretty much how things are, like how innovation happened in DeFi several times. And that's a very important point for interest market in general in DeFi, because that's also how basically it evolved progressively. I mean, how you would look at those opportunities and look at the way pools were built progressively as well there. And that's one of the key things, because one thing that often comes when people started to talk about DeFi is, DeFi against CeFi is, look, we have a new financial space, but it's transparent, it's composable, everyone is nice. And eventually, we started doing shitty product with shitty product being on top of shitty product. So very composable product indeed, but that was also a vector of attack, a vector of weakness. And then we had quite some example of things where eventually it's not because it was composable or transparent, more or less, then things would not, that human nature would change in its manner of assessing risks. And yeah, there was this paper wrote back in 2020 already, where it was assessing risk both in the governance perspective of Maker actually, and different types of lending pools where it would basically highlight like some kind of dominoes effect that could be caused with just leverage, because we are building naively primitives and protocols on top of each other without necessarily assessing how things can break in a very much domino kind of way. And on the other side, while we had those failed experiments, while we had those very short cycle and crazy APIs, we had those protocol growing and growing, and DeFi moved from a few millions to hundreds of billions of TVL and volume. And eventually, while we were very happy with our 4 or 5-digit APIs at the beginning, the base protocol, the core protocol that were accumulating organically liquidity and volume, so their interest rates decreasing by quite a bit. And even very recently, as market conditions changes, and everyone was thinking, like when the price will not go up every day, I will just put my money in a 20% stablecoin, and eventually other things happened. And that's an important point because often, while at the beginning we were comparing CeFi against DeFi on, I don't know, principles, values, openness, that kind of thing, eventually it's also a way of just arbitraging things, arbitraging the market, arbitraging the liquidity and the way you can generate revenue with providing liquidity with a capital that is small in a very peer-to-peer types of way, and generating more interesting interest that you would have with TradFi. But eventually you had actors that would come from TradFi, yield funds, bigger actors in general, centralized exchange just farming with the money deposited in the exchange to propose the user with an interesting interest rate, that kind of thing. Eventually you would have an arbitrage that would come there, and that would progressively decrease a lot the interest rate. But at the same time, DeFi became more usable. At the same time, it became more interesting for new types of actors and bringing more volume and still generating quite interesting revenues. But there is an important point there, is that when people were comparing interest rate, they were still doing that in their browser. They were still doing that by comparing what one website would say against the other. In the beginning, it was AV between compound, and now it's yield dashboard, and you're trying to find the best pool, and you will move your funds from one to another, assessing different kind of security premises or no security premises. But still, it was very much an implicit market. People were speculating with no means of speculation. And that was a very important point, because then, with a few people in 2020, after this DeFi summer, after people were speculating that, not a big shot, but that 5-digit APIs were not sustainable, then eventually we thought about, okay, how can we speculate on that? How can we arbitrate the fact that people are just comparing liquidity pools in their browsers, and by the information provided by the very website that is selling you its own product? And then the yield primitive came into place. Basically, how would you tokenize yield to be able to trade yield directly? Because once you do that, then you have an explicit market. Then you can put it on an exchange, you can sell it, it has a value. And the question about what is the yield, what is the API tomorrow, takes a different meaning. And that's what we started with APWine. So iterating as quick as we can, but understanding that it's a market that was not yet in place in DeFi, and no education, and several things that I'm going to dive in. But first, just to explain a little bit how it works quickly, it was a very, very simple idea. It was an idea that when you have a liquidity, like an interest-generating position in DeFi, you have an interest-bearing token, a liquidity pool token. And then we could just take that token and split it in two. One being the original deposit, the principal token, representing 1 unit of underlying, and the other representing the yield that was generated by that asset. And just by splitting principal from the yield, then you can trade the yield, and then you have this explicit interest market. The thing is, then we launch, and then basically, here is how that looks. Confusing. When I was on a panel yesterday, and we were thinking about like what are the missing things in Web3, DeFi, crypto, and like UX is one of the big challenges there. Like talking to users that are not necessarily educated with the knowledge or the background that usually people that are trading, for example, interest rate are. But just to decompose a little bit the interface, because I want to highlight a few things. First, we were thinking, okay, now the yield of tomorrow has a different meaning, but we still need to know what is the yield currently. And how do you want to have this information? Do you want to go on the website of this very sexy lending protocol, or this yield aggregator that is displaying interesting interest rate? Not really, because one of the reasons why we were doing that in the first place is because we were thinking that they were not arbitrage in terms of how true this information is. So we started to recompute on a backend or front end all interest rates of the pools that we were integrating, which led to a flow of users that were saying, why on APWine you would earn less interest than on this pool, when actually, if we go on this website, it shows a higher API. I mean, of course, there was like the APR API thing, but one other thing is that while we were recomputing interest rate, we realized how not standardized the way of displaying and computing APIs were. And that's something that people realized because they deposited a very round number of funds in a pool, they waited a little bit, they computed the interest, and it was, in a very surprising way, quite different. So that was the first interesting thing. But then at the same time, the goal of that was to make an explicit market, as I said. The thing is, when we launched these derivatives, let's say that even if we knew it was going to be complicated to give a price and assessing what should be the value of the yield on Aave for a month, let's say that users were more or less, we will call it experimenting with pricing models. But basically, very volatile, very uncertain, a lot of questions. How should we actually behave with that? What should we actually do with those interest rates? And that's like the basis on top we iterated a lot, thinking about how the reality about DeFi, the DeFi user need to be addressed, and how we need to take that level of complexity and either give it to a protocol that will manage it, because that's also one thing that evolved a lot. DeFi builds more complicated tools because people with skills or protocol with the ability or the goal of managing this complexity leveraged it to bring efficiency. And so that's one thing, is build layers where you have something that is very complex, not very interesting at once, but if you leverage it correctly, then eventually it becomes efficient, more efficient than something simple. And so progressively and very recently, DeFi Llama launched a yield dashboard, which was kind of a game changer because even though we were watching the prices of assets at a frequency that that everyone has its own, it was not really the case for yield, even though they were even more volatile actually, even though you had maybe the majority of your assets counting on the yield that was generated by those, but still those APIs were pretty much a bonus because who knows what you'll have at the end. And that's pretty much where we are, where we have when we have a lack of information that is addressed by this dashboard, when we're starting to have not just APWine, but other protocol addressing the interest market in different ways, trying to build different derivatives with different premises as well. And basically, going to the direction of having something that is more arbitrage, something that is not just relying on the two websites that you were comparing to see which pool for your USDC is best. And one other thing, I talked about the fact of building simple strategies, leveraging the low-level primitive that we built and that people are building. And fixed rate was an example. And fixed rate was very easy to think about because, basically to explain, it's those fixed rate, at least, is you buy an amount of locked underlying for a defined amount of time with an underlying that is not locked. So let's say you buy more USDC locked with 1,000 USDC, so more than 1,000 with 1,000 USDC. And then you know that in the 8th of June, you will do the locked USDC will become unlocked, and therefore you will have a profit computed on the interest generated, more or less. And that was the first thing, very easy to do, because it's a way for people to hedge their risk, right? You would maybe earn less than if you deposited in a platform and if the API displayed was right, but who knows if it's right or not. And that's basically how the market, in a very simple way, can arbitrage how much interest do you think there will be at this date. So how discounted an asset needs to be if it is locked because of the capital, the opportunity cost it represents. And then progressively, people start to think about different strategies as well. Because if you think about it, interest rate are the price of liquidity. And sometimes you have a very high interest rate, very high yield-generating opportunity with an asset that is volatile, so people don't necessarily want to engage with it because they will lose more money with the market exposure of the asset. But this asset is actually pretty liquid, and you would be able to take a fixed rate and short the locked amount that you have at a lower rate than the rate that you would generate by basically generating yield with that asset. And those are dynamics that start to evolve, where you see actually interest rate going towards different directions because people understand how they can manipulate it and what it represents. And another thing with interest rate is it exists in some ways with not just pure DeFi product or pure financial product. It exists with real estate, it exists with other types of stream revenues. And that's something that we're addressing as well, because then once you tokenize it, and once you give a market for that, then you can have different kind of interesting mechanism where you can get your rent in advance, sell your salary in advance, basically what was the case with liquidity providers, but for another class of actors as well. And then, as I was saying, the more protocol are building there, the more amazing ideas we have from hackathons as well, the more strategies we see leveraging the fact that you can interact with interest rate in an explicit way. So it can be compounding, it can be fixed rate, it can be arbitrage, but it can be capital efficiency as well, because a lot of protocol require collateral for a fixed duration, for an amount of time that is defined. But this collateral is not used to generate yield, or even if it's used to generate yield, it represents a fixed cost at the beginning because you don't know how much you would have at the end. And actually, we're discussing with protocol building financial instruments, but that know how much Ether they need at the end, which basically can be converted to how much locked Ether do you need to have unlocked at the end, hence representing an opportunity to collateralize this instrument with locked token that represents an inferior capital cost at the beginning, therefore an optimal capital efficiency. And yeah, just like those types of things, we see people coming up on Discord, we see people interacting with us because they know like the value that you can take from just arbitraging interest rate between pools with the current market, because the interest rate evolve quite fast depending on market events, depending like market cycles, like just events in general. Those interest rate, those yield actually are also those also come from the usage of protocols and like all those governance token with the staking mechanism. And basically, we try to be as well the pipe.com of decentralized finance, where you can speculate on basically the revenues of a protocol, that kind of thing. So we see a lot of those opportunities, and it's still at a stage where A lot of different protocols are trying to tackle this issue, are trying to build their derivatives, but it's a huge market, and we're all trying to address different axes of it. And it's something where we even try to collaborate to build the groundwork, the framework, and the tools that allows traders, mainstream users, mainstream DeFi users, let's say, or even bigger actors, DAOs, funds, to use DeFi in a safer way with more tools to arbitrage things, to hedge your risk, to speculate on new information rather than the price of asset and a bonus yield that you would have or not at the end of the month. Yeah, that's it for me. If you have any question, feel free to ask. Any questions? Yeah.
I deliberately chose the furthest spot, so he has to run all the way to here. Sorry, I want to ask, when you split to this principal and yield token, can their values float on the market?
Sorry?
Does like the principal token has a floating value or fixed? Can it float on the market when people trade?
Yeah. The way we build it is at the lowest level possible, without any liquidations, anything like that. So a principal is collateralized as soon as you generate it. It's collateralized by 1 unit of underlying. Let's say that you deposit 1,000 ADI on APWine, then you, more or less at the beginning you would have 1,000 principal tokens representing those ADI. And then whatever the yield will be from those ADI, the yield generated, will be captured and put in the future yield token. So whoever will have the principal token can redeem the initial deposit, and whoever has the future yield token can withdraw the interest, the yield generated by this deposit.
Okay, but can people trade the principal token?
Yeah.
On price is different than 1,000?
Yeah.
So like if it trades on 900, then there is another, there is still yield in that, between 900 and 1,000.
While we built the tokenization primitive and we create those derivatives, one huge challenge was creating a market for that, creating a marketplace. So designing custom AMMs that make the liquidity provision efficient in different ways. But basically, most of those assets are tradable. So you can trade your future yield token, you can trade your principal tokens. And that's actually how you get fixed rate with principal tokens, or selling the future yield token at a fixed price as well. Because the principal tokens, as they represent a locked amount of underlying, they're sold at a discount. And from that discount, you can imply some kind of interest over a fixed duration to represent the expiry of the lock.
Okay, thanks.
Of course. Any other question? All right, thank you.